Welcome back to another episode of The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself. Today we're going to look at Berkshire Hathaway. Yes, the investment vehicle of the celebrated, the well-known, the world's richest man, Warren Buffett, sometimes called the Oracle of Omaha. Sometimes he's just the Wizard of Omaha. He's sometimes also the second richest or the first richest man in the world. Nice story, nice stock, especially if you consider that Warren Buffett has been making millions, not just for himself, but for his investors since the 1960s. The stock, however, isn't a traditional company. You're not buying one company called Berkshire Hathaway, even though that company was and is an insurance company. It does traditional insurance. It has Geico, the car insurer. It has other reinsurance companies, and it's a traditional company. The reason you buy Berkshire Hathaway, and here's the success story from the last 10 years, showing the stock going from $75,000 a share to about $217,000 a share now. Big success story. But I also hear you saying, Matthew, what's going on with this stock? $217,000 a share. The A shares of Berkshire Hathaway have never split. They've never been recalculated to be in that sweet spot, say between $30 and $100 a share. They've just let them accumulate. There are other ways to buy Berkshire Hathaway for lesser mortals. They can buy B shares, which do track the A shares, but at lower prices, so it doesn't quite seem like you're parting with your entire fortune to buy one share. But Berkshire Hathaway is a hybrid. It's a hedge fund. It's a mutual fund. It's many things in one. But what do they own? They own about 24% of Wells Fargo Bank, one of the great banks in the United States. They own 15% of Coca-Cola, in itself a great franchise. They own 5% of Walmart. And then they own a lot of other companies, Duracell Batteries, Burlington Railways, 100% owned. So Berkshire Hathaway has percentages of large companies and then owns and controls outright many companies. What's Buffett look for? Well, Buffett's traditionally a value investor. He wants to buy a dollar for 85 cents, and he wants that dollar to grow to $2, to $5, to $8. He wants to buy into markets that are not prone to endless competition, so not quite. The word monopoly is evil. The word oligopoly is less so, but he wouldn't mind buying one that has a captive market. Doesn't want to pay too much, and he wants managers that are going to manage the business. The question for you is, do you want to own part of the Buffett story, or do you want to wait and maybe see if the Buffett story revalues itself to something more normal? It's 17 times earnings. That's not an expensive price to pay for a well-managed investment fund. But the question I have with Buffett and his great success story is simply the age of the management. Buffett's 85. His chief operating officer, Charlie Munger, is 91. And that's, maybe in China they'd be called the kids, but on Wall Street, that's something that's going to be hard to replace. It's a great story, Berkshire Hathaway, as has been the career of Warren Buffett. I'm not sure I want my money with a management that has been so reluctant to change. Well, that's all the time we have today on The Investment Advisor. I'm your host, Matthew Stevenson, in partnership with Dukascopy TV. Remember, money can take care of you, it cannot take care of itself.